All right, folks. So part C of lecture 16, money and banking. We were about to talk about what monetarists believe. Last 16B, we ended with the velocity of money. So what is it that monetarists believe? As I mentioned before, there are various schools of economic thought. Many people think that Keynesian is the only school of economic thought. It's one. It may even well be the dominant school of economic thought, but it doesn't mean that all economists are Keynesians or all economists subscribe to the Keynesian school of thought. So monitors believe that the macroeconomy is inherently competitive and that provides a high degree of macroeconomic stability. Contrast this with Keynesians, and Keynesians are not entirely sure, or they don't entirely agree that the macro economy is highly stable. So monetarists, I'm not going to say are taking the complete opposite point of view, but I guess they have a little bit more faith in the stability of the macroeconomy. Monitors also believe that a constant rate in the growth of the money supply equal to the long-term growth rate in GDP. So what that means is that if the economy, let's say, has a long-term growth rate of 2.5%, then the money supply should increase by 2.5% per year. What's interesting about this is that there may actually be a strong case for this. So I'm not sure if this is still true, but like I think Australia has gone 30 years without a recession. And when it comes to monetary policy, the impression that I'm under is that they are employing, in fact, this long-term growth rate in the money supply. So maybe one of the reasons why an economy goes into recession or experiences an economic boom is because of changes in the money supply that might lead to that kind of stuff. Monitors believe that a constant growth rate in the money supply would show up in changes in prices, wages, and interest rates over the business cycle. So if the economy is strong, and let's say it's exceeding that long-term rate of economic growth. Let's say that long-term rate of economic growth is 2.5%, but we're only growing the money supply by 2.5%. Now the economy is growing at 3%. Then this relative shortage of money should lead to prices maybe being a little bit lower than they would. Might also lead to wages being a little bit lower than they would because you don't have as much money chasing after workers to get them to jump ship. And maybe the interest rates would also, because they're not increasing the money supply as much, rise. So that would prevent an overly speculative investment environment. Interest rates will take up the slack over the business cycle if the money supply grows at a constant rate. So the idea is that if, like I say, we're in an economic boom and the economy is growing faster than its long-term rate, but the money supply is only growing at its long-term rate, then we would expect the interest rates would rise. On the other hand, if the economy is slowing down, let's say the economy is only growing at 1% per year, and let's say that we continue to grow the money supply at the long-term rate, which you said was 2.5% per year, then we would expect to see lower interest rates, and that can actually help the economy when it's slower. Monitors believe in the non-neutrality of money in the short run and the neutrality of money in the long run. There used to be a big debate between monetarists and Keynesians about the role of money, and I think that's pretty much settled now. I think both monetarists and Keynesians will acknowledge that the changes in the money supply in the short run might have an effect on the economy, and Keynesians believe that the changes in the money supply in the long run are not likely to have much of an effect, which is what monetarists have contended all along. Another area where monetarists and Keynesians differ is in what we call the monetary transmission mechanism. So Keynesians believe in the indirect monetary transmission mechanism. Monitors believe in the direct monetary transmission mechanism. And I'll show you that in graphs in the next slide or one of the next slides. Monitors believe that while the velocity of money is not stable, it behaves in ways that are predictable. So they believe that it can be estimated, even though it may not be stable. And monitors also believe that changes in monetary policy can have as much of a destabilizing effect on the economy as a stabilizing effect. So one of the arguments made when an economy goes into a recession is that the Fed should jump in and do something to stabilize the economy. Monitors say, well, yeah, but it can have a destabilizing effect as well. All right, so what do we mean by the indirect versus the direct transmission mechanism? So over here on the left, I show you the direct transmission mechanism, and the story goes something like this. According to Keynesians, if the money supply were to increase, that would show up in a lower interest rate. That lower interest rate would show up as an increase in aggregate demand. Or conversely, if the money supply were to go down, all other things being equal, according to Keynesians, we would expect to see an increase in the interest rate, which would lead to a drop in aggregate demand. Monitors say, well, you know what? It's not even that complicated. I mean, there's only two steps from changes in the money supply to a change in aggregate demand. Monitors say it's simpler than that. If we increase the supply of money, that'll lead to an increase in aggregate demand, regardless of what is happening to the interest rate. It could be that the interest rate is rising, it could be that it's falling, but just the fact that we supply more money should lead to an increase in aggregate demand. And conversely, if we cut the money supply because there's less money in circulation, that should lead to a decrease in that. All right, what's another area where monetarists and Keynesians see the world differently? Keynesians believe in sticky prices. In other words, Keynesians believe that people are slow to change their prices, especially on the way down. And workers are also low to give wage concessions, so we don't expect to see wages dropping. Keynesians believe in sticky wages and prices. So in our aggregate supply, aggregate demand model, the way we show it is that the short run aggregate supply curve, when we have sticky prices, is a horizontal line at whatever the price level happens to be. And as we get closer and closer to the full employment level of output, we then would transition on to the long run aggregate supply curve, and any increases in aggregate demand would now all of a sudden show up as we'd start seeing increase in the price level. Monitors believe that the short run aggregate supply curve is upward sloping, or at least as we get closer and closer and closer to the long run aggregate supply curve, so that if we do get increases in aggregate demand, it'll show up in prices as well as GDP. So imagine, just try to imagine we're over here at 82. Q2 is the price level. Q2 is the equilibrium level of GDP, and the price level is over here at PL1. If we're in the recessionary gap and maybe there's a need to increase the money supply or do something to stimulate the economy, if your view of the world is the Keynesian view, then we will move from Q2 over here to the full employment level of output without seeing an increase in the price level. If, on the other hand, your view of the world is the monetarist view, and we're over here at, let's say, Q2, this increase in the aggregate demand curve will show up in part as an increase in GDP, but we'll also see an increase in the price level. And if we compare, let's say, Q1 on this side to Q1 on this other side, then anytime we get an increase in aggregate demand, let's say from 81 to 82 or from 82 to 83, there's no increase in the price level at all. Whereas if the monetarist view holds and we start off over here at Q1 and we get an increase in aggregate demand from 81 to 82, then our increase in real GDP is going to be less than it would be according to the Keynesian view, and the increase in the price level is going to be higher than it would be according to Keynesian. So that's an area where monetarists and Keynesian see the world a little bit differently. Now, with respect to the neutrality of money, as I mentioned before, in the long run, changing things like the quantity of money is not likely to have an effect on things like real output, real wages, real prices, real GDP, etc., because the amount of money is not really related to how much we're producing or what the cost of production is in inflation-adjusted terms in the long run. So an increase in the money supply could lead to an increase in the price level, and then that increase in the price level might actually lead to a decline in nominal GDP once we strip out inflation, and that would have zero effect on real output in the long run. So again, most economists today accept the neutrality of money in the long run, and that's one of the reasons why the Fed is less likely than in previous times to just increase the money supply to try to do something about the economy. All right, let's talk a little bit about inflation and deflationary tendencies. So if we change the money supply velocity or real GDP, that could have an impact on inflation. So holding all else constant, and that's what we do in economics, an increase in the money supply or an increase in the velocity of money or a decrease in productivity all by itself will be inflationary in nature. On the other hand, if we have a decrease in the money supply like we did during the Great Recession, when people who borrowed money to buy homes could no longer repay it, that would be deflationary. If we had a decrease in the velocity of money, I showed you that graph of the velocity of money over time, and it's gone down recently. That would maybe another reason why we're in a relatively deflationary environment, or we have an increase in productivity. I mentioned that deflationary pressures led by increase in productivity is actually the good kind of deflation because it's not based on insufficient aggregate demand. It's based on using our resources more efficiently. So any of these things over here on the right are deflationary in nature. Anything over here on the left is inflationary in nature. So let's talk a little bit about financial crises and the potential effect that they have on the real economy. I think it's safe to say that the financial crisis of last was a big part of the recession. I think it's also safe to say, without the benefit of knowing what would have happened without intervention, that we didn't go into a depression, perhaps because we had the right kind of intervention. So I want to talk about a few other financial crises before we end this lecture and end the semester. So one example of a financial shock that did not lead to a recession was an event called Black Monday back in 1987. The Dow dropped by 22.6%. In fact, they had to stop trading. They kind of had to take a time out for a little while and stop trading because they were worried about how fast the market was falling. Alan Greenspan just was appointed like a month earlier, I think, or maybe even a few weeks earlier, as head of the Federal Reserve. He knew exactly what to do. He increased the money supply. He allowed banks to borrow liberally at either the discount. Well, in those days, it was a discount window where most of that activity took place. Also, the economy had been in an economic recovery for a relatively long period of time. If you go back to the 1970s, you'd see that the economy was very anemic, and we had a deep recession in the early 1980s. And by 1987, we were in a pretty strong recovery. So a lot of people were saying, well, we're overdue for a recession because don't recessions happen every 3 or 4 years? So as a result of Greenspan's actions, the economy did not go into recession, which is good news. In fact, it continued growing for about another 3 years or so. There were some other events, financial crises in the 1990s that also did not lead to a U.S. recession or a global recession. One of them was the savings and loan debacle. There used to be a set of lenders out there known as savings and loans, and their purpose was to take deposits from people and lend out to people who wanted to buy homes. Fairly boring business. In fact, now that we're coming up on the Christmas season, some of you may watch that movie, It's a Wonderful Life with Jimmy Stewart. If you do, or if you have in the past, you might remember that Jimmy Stewart worked for Savings and Loan. If you haven't, maybe now's a good time to see the movie. I don't know. But anyway, the idea was that these institutions called Savings and Loans primarily took deposits from people they knew. They got to know the borrowers that were coming in to borrow to buy a home, and they wouldn't lend them too much, and they would lend them the right amount of money. Well, things got a little interesting in the 1980s. We also had another real estate boom. By the early 1990s, most of these savings and loans had basically gotten wiped out, and that was what was called the savings loan debacle. We went into a mild recession, but I'm not sure it was a result of the savings and loan loans crashing and burning. We also had a war in Iraq, the first Gulf War, and a few other things thrown into the mix. In 1994, we had the Mexican peso crisis. Mexico had was about Mexico and the United States were about to become closer in NAFTA. Mexico also managed to get their inflation under control in the early 1990s. They issued a new currency. And then all of a sudden, 94 was an election year in Mexico, and the dominant party there, the PRI, they wanted to win one more election. So they were doing a lot of interesting things, shall we say, with the money supply to keep the economy going well, so people would vote for PRI. And then after the election, because they couldn't keep up these facades, they let the peso drop. I was in Mexico at the time. I remember that very well. The peso went from 3 to the dollar to 6 to the dollar in a matter of like 2-3 weeks. So, like, if you had your money in dollars, your purchasing power doubled as a result of that. Another thing that happened in the 1990s that did not lead to a recession was the Asian financial crisis. So there were these countries called the Asian Tigers in the 1970s or 1990s, excuse me. A lot of money were flowing into these countries because they were viewed as being the growth countries of the future. Then a thing happened in Thailand. Thailand wasn't even one of the Asian Tigers, but it scared people because people thought, oh my God, if that's what they can do in Thailand, if they can impose currency controls and impose to keep you from removing your money, what would happen in these other Asian tigers if they did the same thing? So to make a long story short, that created a financial panic for a lot of people, but it didn't create a recession or anything like that. Then in 1998, a hedge fund collapsed, and it had wider effects throughout the economy, but the economy did not go into recession. And then in 1998, Russia decided they weren't going to pay their bills anymore. They didn't think it was important to do that, and so that also had impacts on the financial market, but it did not have impacts on the global economy or even the U.S. economy. Then one final event and its impact on, or lack of impact, I guess we could say, on the economy was September 11th. The economy was already in recession in September 11th. It had been since March, and we got hit by an attack in the financial district in New York. What was the Fed's reaction? The Fed's reaction was to provide a lot of liquidity. So banks, the Fed increased their direct bank loans at the overnight window from 99 million on average to about 45.5 billion. That's a huge increase. You're going from 100 million to 45.5 billion. That's really big. The reason they did that was because they wanted to provide liquidity at a time when banks were, or when a lot of people were wondering what was going on because we were attacked. The Fed increased the Federal Reserve float from 2.9 billion a day to 22.9 billion a day. So float is, and I don't even know how valid this is anymore because very few people use checks anymore. But back in the early 2000s, there was still quite a bit of activity taking place in the form of checks, and the Fed's role in checks is that they clear checks. So what they will do oftentimes is they will credit a deposited check before they know whether or not that money is available, and they'll actually be the same amount of money in two different bank accounts. So the issuer doesn't have money removed from his bank account, and the depositor of the check has money credited to his bank account, and that's called float. So they increase that from 2.9 billion a day to 22.9 billion a day. The Fed also bought $30 billion in securities to add liquidity to the economy, and they basically provided foreign banks with enough money that they needed to prevent defaults. We actually came out of the recession that we were in November, so it seems like that had the desired effect, so to speak. So the point I'm trying to make is financial crises don't always lead to recessions. Maybe it's more fair to say that it's the response to a financial crisis or the lack of response to a financial crisis that might lead to a recession. All right, we're done. Thanks a lot, folks. I will be seeing you on